Today's question comes from James in Wyoming. He says, I'm 28 years old and I'm on baby step 3. I'm looking ahead to baby step 4, where my fiance and I will invest 15% of our income into retirement. What are your thoughts on dividend investing? I was thinking after the house is paid off, the only thing better than no payments is having passive income from our investments covering our living expenses. I want to achieve this before the age of 60, when we can start withdrawing from our retirement. Is this a good way to allocate our 15%? And if so, how does receiving a dividend work with a Roth IRA? Is it still taxed? Great questions from a 28-year-old. I'm impressed.
Oh, very good. Very good. Well, a dividend-paying investment would be typically what's called a blue chip company, a large company, okay, like a General Motors, okay? They're not usually very exciting in their price changes, up or down, but they make a lot of money. And so when they make money, and when you own a share of stock, you're one of the owners of the company. You own a tiny little piece of the company when you own one share of General Motors stock. If they make a profit and they decide to distribute that profit to the owners, that's called a dividend. And so a dividend-paying investment would typically be large company stocks that are paying out their profits and are fairly predictable on that, and people buy them for that and that only. If that's in a Roth IRA, the dividends stay inside the Roth IRA until you're 59 and a half. It's tax-free like anything else is. But and what you would do is flip the dividends and they reinvest back into more stock is what happens inside of that. You cannot pull anything out of a Roth IRA before 59 and a half without getting penalized and taxed. And so we're not going to use that for something to get too early. And I really wouldn't do it. If you want to invest, I would just do 15% of your income into the 4 types of mutual funds we talk about: growth and income, aggressive growth, and international. If that gets too big and you're getting close to 50 years old and you don't have any money to support you between 55 and 60 or 55 and 59 and a half, then you might just start with something like some index funds. And that's called bridge investing at that point.
Which is a taxable brokerage account where you just invest, and it's all going to be taxed when you take it out. But that could be a way.
It's a taxable mutual fund.
Yeah.
That's what it is.
So with the Roth IRA, just leave it in there. It'll be reinvested. It'll still help your money grow. But I wouldn't worry about this as a passive income strategy.
Yeah. You've been reading too many websites.
Passive income is great when you're in retirement and you get the passive income from that investment.
From that Roth IRA, and it's a tax-free income. You don't need passive income. And typically these are the calmest of the 4 types. Okay, the growth and income. It's a growth and income type stock that would be a dividend paying.
The and income part.
Yeah, and that's those blue chip big dinosaur companies, and it's the least exciting, the least rate of return. It's the lowest rate of return of the 4 types we talk about and that I own. So I'm 61. I did none of what you're talking about. All I did was buy real estate that I pay cash for and invest in those 4 types of mutual funds in my 401k. That's really all you need to do if you up to tens of millions. I mean,
you don't need to get fancy.
It's won't make you a billionaire, but you won't be broke, and you'll be a millionaire and a multimillionaire.
You'll end up somewhere in between.
Absolutely.
Well, you've reached the end of the video. If you are interested in learning more about similar topics, here you will find other really interesting videos from the channel. Thanks for watching this video. Click on the like button if you enjoyed it, and do not forget to subscribe in case you didn't. See you on the next one.